Good evening, everybody, and welcome to our Zoom broadcast for November 11th. Thank you for tuning in. We hope you're all healthy, happy, and safe. We know there's some more registrants to come in, so we'll just do some kickoff stuff and allow them to get in. It's been a while since our last broadcast, and an awful lot's gone on. We'll talk about some of that tonight and entertain your questions as always. And again, hope you're healthy and safe as we deal with this craziness that's going on in our world. I'm going to turn it over to Sharon in our world headquarters in Augusta, Georgia, so she can give you some technical information about how to ask questions. And before I do that, I want to encourage you to ask questions because any of you who have conducted a Zoom call, you're looking at a screen and it sure is nice when people ask questions. And she's also going to tell you tonight how to turn your audio on and ask a question. Don't be scared. If you got that question, probably everybody else does too. So with that, I'll turn it over to Sharon.
Okay, yes, we would really like it if you would ask questions. You can always find your toolbar and post your questions in the chat room. If you want to be more anonymous, you can send them just to me, or you can post them out to everyone in the chat. If you would like to just talk so that you can maybe better say your question or have follow-ups to your questions, just let me know that and I will unmute your mic and you can talk to Gene and, or the others. We have Tom on and Clayton, so you can ask everyone their opinion. All right.
Thank you, Sharon. And when we talked about it, we thought sometimes when people post questions, something may be lost in the translation. So feel free to ask those questions and use your mic. We'd love to hear them. As Sharon mentioned, we've got other team members on the Zoom call, Tom O'Gorman and Clayton Kwame, and I hope as usual, they will jump in and edit and correct me as necessary. It's been a crazy time. We've had the election, so we want to talk about what this 2020 election means for investors. But before we get started, as usual, we're going to talk for about 20 minutes, and then we're going to open it up for Q&A. Tonight, I'm cooking, so I have to pick up the food by 6:30. So I do have a hard stop tonight, unlike other times. So, but we'll have plenty of time for questions. So let's get to it and get started. And I'll share our screen here and pull up a couple things that hopefully will have some meaning here. All right, Gene. There we go. Okay. So let's just dig right into it here. As always, we like to talk about how we look at investments and investing. And at the top of our triangle here, inverted triangle, is asset allocation. We'll refer to that some during our talk tonight. And at the bottom is security selection or stock picking. Again, this is called the efficient frontier. We'll actually talk about profile 3 here, or a model portfolio, some tonight. But what you want to do is balance risk and return and come somewhere on this efficient frontier. So the big picture, the politics, we want to talk about the politics tonight because that is certainly affecting financial markets. And like everybody, we were uncertain about what was going to happen and who was going to get elected and what was going to happen with the Senate, how it was going to affect the markets and affect our pocketbook. Well, I'm fascinated by politics, and I think it's very interesting. It appears by all accounts that Joe Biden will be our next president. That's going to be challenged at some point, I think, but I think he'll end up being our president. And I think it's interesting that he's a centrist. He's a Democratic centrist, not part of the liberal or progressive wing, and that was taken care of when he was nominated. But I think it says a lot about how the country feels about a liberal or progressive wing of the Democratic Party. That was very much repudiated because there was no landslide. If you recall, probably a week or two ago, some fairly conservative publications were predicting a 10% win by Biden. That did not happen. And there was no blue wave. and the context of that and the importance of that is this, that although the Democratic Party is often painted as fiscally liberal, I don't think that's what the country wants. And to that bullet point down here, the electorate spoke and said that they might not have been happy with the last 4 years of Trump, but fiscally they liked the direction we were moving into. And that certainly has an effect on the markets as we talk about those and move forward. There's a couple of different areas, but certainly a dichotomy between policy and fiscal policy. And on the whole, it seems like the country spoke through the ballot box and said, fiscally, we like where we're going. I put this down here. It's the economy, stupid. If y'all remember when Bill Clinton was running for president, James Carville famously said, it's the economy, stupid. And then I put, until we have a worldwide pandemic, because although it mostly is the economy, when we're in the midst of a pandemic, certainly that was a big deal as we move forward with politics and the elections. So what does this all mean? Well, let's review. For those of you that have been on this call before, we know the markets hate what? Uncertainty. They don't hate that Biden might be elected president or that our current president might be elected, Trump, but they hate the uncertainty because they don't know how to act. They don't know what to count on. They don't know what policies are going to be in place or how spending is going to take place. So we no longer have uncertainty. The uncertainty is gone after the election, whether you like the results of the election or not. And now plans can be put in place based on known facts. Those facts, as I mentioned earlier, are that more than likely Joe Biden's going to be our president, but also more than likely we're going to have a divided government. It looks like, to be determined, that the Senate is going to tilt slightly Republican, which would limit the president's ability to enact everything he wants to. And the markets have reacted favorably to that, very much so, as seen over the last 7 days, which we'll talk about. Also, as everybody has seen, there's news of a vaccine by Pfizer. Well, with this recent news of the vaccine, as you know, the markets went up substantially on Monday because the uncertainty starts to go down because there's a light at the end of the tunnel that perhaps there'll be a vaccine and we can get back to normal, whatever normal is. And then with the divided government and gridlock, that, as I mentioned, that means that there are less extreme measures either way. We're not going to have the volatility, more than likely, of President Trump, where he spoke oftentimes out of both sides of his mouth or changed his mind. And conversely, as I mentioned, because of probably a Republican Senate, we're not going to have absolute authority by the president. So moving forward, this is interesting. The Dow closed yesterday above its all-time high of February 21st. And I underscored this in the midst of a pandemic. I want you to think about that. We all got concerned when we learned of the pandemic back in March and so forth. But it's really incredible that right about here, I am getting fancy with my drawing, we were at an all-time high. And then here's where our panic set in down here and things were not good. Well, here we are 6 months later, and we've actually exceeded where we were. And we'll talk about that in a second. But I think that is absolutely remarkable that we've come back so fast, so quickly. And in our office back over here, we were talking about, gosh, we have really run up in the markets. Is this sustainable? And now here we are right back at that spot 6 months later in the midst of the pandemic. So I think it's just really interesting and really worth noting that we've come back that quickly, and we'll talk about that. Okay. All right, so what do we do now? Based on all the information I just talked about, based on some certainty about the election and what's happened to the markets, what do we do now? Well, here's a couple of things. One, watch interest rates. For those of you that have participated in our briefings before, we reference the 10-year treasury rate many times, and I want to review why we watch that so closely. So a 10-year treasury bond is a bond issued by the US government that they will pay interest on, and in 10 years, you'll get your principal back. The last time we had a presentation, the 10-year treasury bond was paying 0.7%. It's now up to 0.9%, not 9%, but 0.9%. But we build a return or a portfolio based on that risk-free rate of return. And we call it the risk-free rate of return because if the US government doesn't pay off on their 10-year treasury, then it doesn't matter how much we've got in the stock market or in our savings account, it's probably Armageddon because we are still the biggest government and everybody counts on the US government to flourish and to succeed. So as we begin to think about what our expectations are for the markets, whether it be stocks, bonds, cash, whatever, we know that the risk-free rate of return is the 10-year treasury, which right now is about 0.9%. So we compare all of our investments ultimately with that risk-free rate of return. Are we willing to take the risk to attain more than a 0.9% rate of return? The next bullet point on here is pay close attention to valuations and watch for irrational exuberance. Like I mentioned, is the economy stupid? We were in a meeting this morning and one of our younger team members who's on this call, who has a very short haircut, didn't know what irrational exuberance is. And it is, Alan Greenspan said it in 1996 as technology and the dot-com bubble was getting going. And I think we may be in a similar situation with the run-up we've had based on the graph I just showed you previously. We're in the midst of a pandemic. There's hope for this pandemic, but we're right back where we were at an all-time high 6 months ago, which is kind of concerning. So based on the above, the market has likely gotten ahead of itself. So what does that mean? Well, you've heard us say it before, myself and all of our team, that if you're in the right place when all this started, either when we had the pandemic and everything went to the floor, or we're back up where we are, if you're in the right place, don't change what you're doing. Stay the course. Just because we've had a run up, don't go buy more or don't go sell out. Keep your asset allocation. I told you I would reference our upside down triangle. Keep your asset allocation that's right for you. And of course, that asset allocation is based on your time horizon and your risk tolerance. Part of the way to keep your asset allocation is don't look at the TV, don't look at the web, don't pay attention to social media. Just because that information is out there doesn't mean it's correct, doesn't mean it's good, and most importantly, doesn't mean it's appropriate for you. And then on this slide, the last 9 months and the last 7 days are terrific illustrations of why we can't time the market based on a pandemic or a presidential election. One of the calls that I got and our team got on a consistent basis over the last 2 to 3 months is, what is the election going to do to the markets? And wisely, we said, we don't know what's going to happen. We don't know what's going to happen if Biden wins. We don't know what's going to happen if Trump wins. We don't know what happens if the Senate or House goes Democratic or Republican. Because actually, when you look at the data over the last 80 years, when a Democrat is in the presidency, the stock market does better. And when a divided government, like we think we will have, it does better as well, because there's not too much extreme of policy one way or another. So timing the market never works. And I think it's just a great example of that over the last little while. I want to talk about what AP Wealth is doing right now. And what you see on your screen now is our stock style box. So I'm going to get my pointer out here again. And I want to talk about this. Growth from an equity or stock standpoint, and this should add up to 100%. So what this means is, where do we put a percentage of our stock investments in value, blend, or growth, large, mid, or small caps, okay? So I just want to talk about this growth here that I've circled in green for just a second. Growth has outperformed value handily over the last 5 years. And a lot of that growth, particularly over the last 6 months, has been technology. But just like everything, there's a cycle to it, okay? And as you know, technology is going to be Microsoft, Amazon, Alphabet or Google, Netflix, a lot of, and Facebook. A lot of those have done really well, but they're beginning to get challenges, monopolistic challenges. But the point of all that is we've had a heavy dose, or 30% of our equity allocation has been to growth. And as you'll see in a little bit, a great deal of that is technology. But I also want to point out that 17% of our portfolio is in value. Even though value is out of vogue, value will not be out of vogue forever. And let me pause here and just remind you what growth versus value is. Growth is you buy a stock at a price and you think the price is going higher. The stock has done very well, or the investment has done very well, and you expect it to go even higher. Value is a stock or an investment has been performing poorly, but you think it's going to recover. So I mentioned in the growth situation, that would be things like Amazon and technology. On the value side, that would be something like energy, where, as you know, when you go by all the gas pumps, the cost of gas is very cheap and energy has gone down and not performed well. So as we reference diversification and asset allocation, I just want to point out to you that we diversify. Even though we love growth, we still have some value exposure. And the numbers down below represent investments in mid caps and small caps. So most of our allocation is to large caps in the top section there. Okay. Close this. There we go. Oh, we got some leftover annotations from when I was working on it. So here is our equity sector. So where are we investing when we invest in stocks? Well, you can see in my green scribbling there, our number one highest allocation is to technology, almost 20%. And then real estate, healthcare, consumer cyclicals. And you can see at the very bottom, energy is a very small portion of what we have invested in recently. We're beginning to like energy more, but we are watching it very carefully. Again, everything is cyclical. Let me take a second here and erase some of this. I think I figured out. There we go. Okay, so then this is our fixed income box, or bonds. Where are we investing our fixed income portion of our portfolio? Well, you can see right in the center there would be a moderate risk and a mid-range, or not long-term and not short-term investments. What do I mean by that? Well, a short-term fixed income or bond investment would be a CD or a short-term bond, say 1 to 2 years. A long-term bond would be something like 10 plus years, maybe even 15 or 20 years. Well, if you recall, I referenced the 10-year treasury, and it's still at historical lows. So the reason we're in the middle is because if we go buy long-term bonds now and interest rates rise, those bonds are not going to be competitive, because as interest rates rise, you'll be able to buy new bonds at higher rates. And those bonds that we bought at lower rates won't be quite as valuable. They'll pay off, but we'll be sacrificing yield. So we purposefully are staying in the midpoint until interest rates normalize. Okay. Next here is our equity region exposure. And so what you see, a map of the globe up here, we are predominantly in the United States. We like the United States more than we like other countries right now. We still have some exposure in various other countries, but probably 85% of our equity exposure or stock exposure is in the United States. And I need to point out, this is a metaphor, if you will, for our portfolios. We have 1, which is the most conservative, and 5, which is the most aggressive. All of this data is based on the midpoint, or what we call a profile 3. But I think it's a great illustration of where we are and what we're doing. And then finally, the profile 3, or midpoint of our portfolios, what does it look like? Well, moving here, you can see 43% is in US stocks, 8% is in non-US stocks, 32% is in bonds, 5.9% is in cash, and I'll talk about cash in just a second, and then 9.52% are in REITs and various other investments. The reason we have a slightly elevated amount of cash is because of what I referenced earlier. Interest rates are very low. We don't want to lock in. We want to have bond exposure, but we don't want to lock in at these low rates. We want to have some powder dry, if you will, so that in the future, as rates rise, we're able to take advantage of those. Okay. Clayton, would you talk to us about year-end planning, please?
Yes, sir. Can you give me a thumbs up if you can hear me, Gene? I just want to make sure. Okay, good deal. So shifting gears just for a second, everyone, we wanted to touch on year-end planning. That's typically financial planning and tax planning that we help folks with. This kind of just generally, we've run across a lot of these, which is why I wanted to bring them up. Everyone's situation is customized. We're planning for everyone. So others might have other things that we're helping them with, but these are some of the really common ones that we're running across this year. First one, refinancing, given the low interest rates. We're continuing to help clients with that. It's definitely worth looking at if you have not refinanced already or looked at it. Still finding folks, even now that haven't done the refinancing, so go ahead and take a look at it. We expect rates to remain low for a while, but as Gene mentioned, the 10-year did creep up a little bit, and is actually kind of significant from like a percentage-wise increase. So it's definitely worth peeking at. Tax loss harvesting, that has to do with taxable investment accounts and investments inside of those. This year, because of what Gene also showed on that chart, where we had the dip in March, and then we've had a nice steady climb back to where we were. There may not be as many losses to harvest as some would have thought at the beginning of this year. However, we go in each year and just take a look and look at everyone's holdings and decide if it makes any sense to harvest any losses from a tax standpoint. And then Roth conversions, that's got a December 31st deadline on it. There's a lot of things we have until you file taxes on April 15th that we can still take action on. Roth conversions are not one of those. If we're going to do one this year, it has to be done by December 31st. So if you've been considering those, or you're looking at it and haven't pulled the trigger, make sure in the next 45 days you take a peek. Charitable gifts, qualified charitable distributions from your retirement accounts and donor advised funds. Same thing there for the charitable stuff, December 31st deadline. So if you still need to do that for 2020, now is a good time to take a look at it and decide what you want to do, if you're going to do anything different. Required minimum distributions, that's a little different this year. A lot of those were suspended. We've talked to most folks that have had a required minimum distribution and explained to them what we've done, or if they need to take one, or if they haven't taken one. But that does change your income situation. So just make sure you're aware of it if you're in that situation. And that brings us to kind of the last bullet point, which is fall tax planning with your CPA. A lot of folks think, hey, I only talk to my CPA in April or March when I file taxes. Our take is that the fall is actually the best time to be thinking about tax planning, and when your CPA has the most time to think through planning for you. So if you are considering a strategy that may need a little tax planning, now is the time to do it. That way you have a chance to take action at the end of the year to implement some of the stuff that you may decide to do. So not everyone necessarily needs to do that with their CPA, but those that do, this is the time of year to be talking with them. So I think with that, I will turn it back over to Gene.
Okay, Clayton, well done. So I'm going to put a bow on it here and open it up for discussions. But before I do that, I just want to leave you with this right here, this graph of where we are, the recovery that has been nothing short of stellar, and just encourage you to think about rebalancing if you've had a good run over the last little while. We're not sure this will last. It looks like the coronavirus is not going anywhere anytime soon. And based on what all the evidence and news we hear from the Pfizer thing, there's a lot of unknowns that will push any solution to this out into the distance. So with that, we will entertain questions, and we may even call on some people or assume some questions. Sharon, do we have any questions?
We do.
Terrific.
Yeah. And our first question is, assuming Biden is a centrist, and then in parentheses it says, I don't believe that. And then it says his running mate is far from the center. What effect will she have on the market should Biden not make his full term?
Well, I'll take it first, and Tom and Clayton and Sharon, all please come in on it. When I say centrist, a Democratic centrist. So I don't think he's a centrist from a pure political standpoint, but from a Democratic centrist. Kamala Harris, I know a little bit about her, and certainly that's a valid concern, because Joe Biden would be the oldest president to ever hold the office should he become president. Again, the question goes back to, what should we do if something happens? So right now, I would not say you want to take any action. The other thing about our government that I didn't say was we have many checks and balances. And if we have a Republican Senate, there will be a check on Kamala Harris, or there will be a check on President Biden that will make it difficult for them to have carte blanche and do what they want to. So right now, this is probably not the answer that you want, but I wouldn't do anything right now except stick to your asset allocation.
And we have another question. Was there any useful information in the beige book that came out a couple of weeks ago prior to the Fed meeting?
Oh, that was asked by somebody who was on the last meeting when we talked about fighting the Fed. That's a great question. So the beige book, just as a reminder, or for those who weren't on that call, is a booklet that the Fed puts out when they're meeting, when one of their 8 meetings, and it's got a lot of information in there. There wasn't tremendous information that hasn't been disseminated since that point. They are concerned about the economy being able to grow. And I think they reflect exactly what I reflected earlier. And that is, if this virus, if this vaccine that's successful against the virus is in fact valid, how long will it take to get it out there? There's all sorts of challenges. They're going to take a while. And the Fed has reiterated that they will keep short-term rates. Remember, they control short-term rates much more powerfully than they control long-term rates, low for a very long time. And it's worth noting here that when short-term rates are very low, or rates are low, that makes stocks much more attractive. Clayton, Tom, Sharon, anything?
Gene, it's Tom. Just to follow up on one of the points Clayton made about refinancing. I had a client last week I was helping, and we got quoted 2.5% on a 15-year fix. So rates are continue to be really good, and I'm glad to pass that on, that financier, that banker, on to anybody who might be interested.
Thanks, Tom. Sharon, did anybody open up their mic?
No. Wait a minute. I've got another new message here. It says, what is consensus defensive on the allocations chart? Would you like to know who that was from?
Ask the question one more time.
Okay. What is consensus defensive on the allocations chart?
Okay, let's go back to the allocations chart and look at that. Oh, yes, good. Consumer defensive.
Consumer.
Here, consumer defensive. That would be, Tom and Clayton, hop in here. That would be things that we need on a day-to-day basis, whether we have a pandemic, whether the economy's bad, whether the economy's good. Those are going to be staples, groceries, toilet paper, those sorts of things that we have to have no matter whether the economy is good or not good. Great question. Great question.
All the things people were hoarding.
Yeah, right.
Yes, right.
Great. Yeah, exactly. Yeah. The final question, what are you cooking and what time are we eating? Well,
Yeah.
I am cooking a chicken piccata tonight and some sort of vegetable and a dessert. And actually, I'm not cooking it, Steve, but it's the next best thing. I was smart enough to order it and pick it up. My wife is on this call. She's a fabulous cook in addition to being beautiful. Y'all can all see her picture there. And yes, I did outkick my coverage.
And the last question is, how old was Clayton in 1996?
I was 12.
So Clayton didn't know about, well, no, he learned about irrational exuberance in college. So he knew about that, but he knew nothing about it's the economy, stupid. He just gave us this blank stare and we were like, oh my gosh, how old are we?
I told Gene that the irrational exuberance was in my ancient economics book for ancient economics facts.
Yeah. Anything else, Sharon?
That's all so far.
Okay.
Well,
as usual, this will be available on our website. If you want to send this video to somebody, there's a lot of data in here. And as always, if you've got questions or comments or things you want to delve into deeper, we'd be happy to talk with you and talk with anybody else who might be struggling right now or just have some uncertainty. And it's never too early to tell you happy Thanksgiving. We're grateful for all of our clients that are on this call, all of our friends that are on this call, and we hope you have a happy and safe Thanksgiving and wash your hands. Take care, everybody.